Hi everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday 22nd of March. An upward trend for the S&P remains intact. There's still a series of higher highs and higher lows. Buying power is expanding and selling pressure is contracting. These are the normal signs of a healthy and sustained bull market. I am still expecting new all-time highs this year from the S&P, and I am expecting at this stage, with the expanding buying power, pullbacks to be more brief and shallow than otherwise expected. I'm not expecting a deeper, more sustained pullback about here. For the very short term, Monday may see just a little bit of downward movement to 2796. After that, the upward trend should be expected to resume. The midterm target remains the same at 3010, and the final target remains the same at 3045. I do also have an alternate wave count, which is more bullish than that. To see that, have a look at the monthly analysis. Charts are published here, video is published here, so there is a more bullish alternate as well. Elliott Wave analysis first again this week. At the weekly chart level, this wave count sees the end of a supercycle degree fifth wave with cycle wave 5 beginning here. Supercycle wave 5 is subdividing as a 5-wave impulse. Within it, cycle wave 1 is off to the left of the chart. Cycle 2 ends here as a shallow combination. Cycle 3 ends here as an impulse, with the third wave, the end of it, overshooting the Elliott channel. That's a really typical look for the middle of a third wave. Cycle 4 ending here as a double zigzag. That's a fairly common corrective structure. There's perfect alternation between the combination of cycle 2 and the double zigzag of cycle 4. And there's poor proportion in terms of duration, but because cycle 4 travelled quite a great distance in terms of price, albeit over a short period of time, there is good proportion between the two of them. When you look at this movement on a monthly chart, it looks like they should be labelled of the same degree, so that's what I'm doing. If cycle wave 4 ends here, then cycle 5 is beginning. There are only two possible Elliott wave structures. For this fifth wave, it may be a simple impulse, or it may be, less likely, an ending diagonal. I will label it as the more common impulse unless overlapping suggests I need to consider a diagonal. Within cycle 5, I expect that primary 1 was over here and primary 2 was very likely to be over here still. If it does continue, and I do again have an alternate idea, although I am judging it to have a lower probability, and if it does continue, it can't move beyond the start of 1 below this price point. Let's take a look now at the daily chart, where primary wave 1 begins down here, this point down here. This daily chart sees primary 1 over here, and primary 2 a flat correction, relatively brief and shallow over down here. This is my main daily chart because it has support from classic technical analysis. I had expected intermediate wave 2 to find support at the lower edge of this adjusted base channel. Lower degree second waves usually, not always, but usually find support at a base channel drawn around a first and second wave 1 or more degrees higher. That's not always the case though. I am sorry about the background noise. That's the neighbour, and there's absolutely nothing I can do about their Saturday use of power tools. Intermediate wave 2, I'm expecting may be very, very close to completion. It may not move beyond the start of 1 below this price point. The target for primary wave 3 remains the same. It fits with this higher target, which for this wave count, there's a limit to the end of cycle 5, and this target fits within that limit. The target for cycle 5 is for it to reach 0.618, the length of cycle 3 at 3045 to fit within that target. My calculation for primary 3 is for it to reach only 0.618, the length of primary 1. At cycle degree, cycle wave 1 was a very long extension. Cycle wave 3 is shorter than cycle wave 1, and so cycle wave 5 may not exceed equality in length with cycle 3, so that the core Elliott wave rule stating a third wave may not be the shortest is met. And so the target for cycle 5 is for it to be shorter in length than cycle 3. We may see that pattern repeated as a smaller fractal here within cycle wave 5. Primary wave 1 looks like a long extension, primary wave 3 may be shorter than primary wave 1, and then primary wave 5 may be shorter still. That's a pattern that does sometimes unfold for this market. Let's take a look now at the hourly chart where the end of intermediate 1 is this point up here. Intermediate wave 2 is obviously continuing the invalidation point that I had on the last published hourly chart. At this point was invalidated. Intermediate wave 2 is continuing as an expanded flat correction. They are fairly common structures, although the most common place for expanded flats to show up is within B waves. They can also turn up in a second wave position. Intermediate wave 2 can complete as any corrective Elliott wave structure except a triangle. Expanded flats subdivide 3, 3, 5. There is a common length for a B wave within an expanded flat from 1 to 1.38 times the length of the A wave, and for this example minor wave B is within that common range. It's 1.2 times the length of minor wave A. A target is calculated for minor wave C to exhibit the most common Fibonacci ratio to minor A for an expanded flat, that of 1.618 times the length of minor wave A. Intermediate 2 may not move beyond the start of 1. This target expects a small overshoot of the lower edge of this base channel. That's entirely acceptable. If this trend line is breached by at least one full hourly candlestick of clearly downward movement, not sideways, then I'd consider the ultimate a little bit more seriously, but I wouldn't swap the main and alternate wave counts over. That's only going to happen if this main count is invalidated with a new low below this point. The S&P just doesn't always play nicely with its trend channels. Sometimes it breaches its channels, particularly in bull markets, only to turn around and hug the lower edge of a channel. It does that when it forms curving rounded tops. That's a feature of this market, so we have to be a little bit more flexible, unfortunately, with channels for the S&P. At the daily chart level, if the main count is invalidated by a new low below this point, 2722.27, then I would use this alternate wave count. If we move the degree of labelling within this flat correction down 1 degree, this may have only been wave A within a longer lasting and deeper primary wave 2. Primary wave 2 may be unfolding as an expanded flat correction, subdividing 3, 3, 5. A target is calculated for intermediate wave C to reach 1.618, the length of intermediate A. For this example of an possible expanded flat, intermediate wave B is a 1.51 length of intermediate wave A. That's longer than the maximum common range of up to 1.38, but within the allowable limit of up to 2 times the length of A. There is actually no rule stating a limit for how long B waves within flats can be. There's an Elliott wave convention that states when the possible B wave reaches twice the length of the A wave, the idea of a flat correction continuing should be discarded based upon a very low probability. This wave count does not have good support from classic technical analysis. There is too much strength within this upward movement for it to look like a normal, typical B wave. B waves should exhibit weakness. They should be unmistakably weak. And that's not the case within this upward movement so far. Let's take a look at that classic technical analysis, and I'm also using Lowry's data, particularly not just the operating companies only AD line. I'm using their buying power index and selling pressure index. Buying power has been expanding as this upward movement rises. Selling pressure has been contracting and is now within just a very few points of its all-time low for the entirety of the bull market, which began back in March 2009. With such low selling pressure at this time, I'm not expecting a primary degree pullback to be a deep sustained pullback. Also, with the AD line making new all-time highs prior to price, and I read that as a leading indicator, I have confidence that this upward movement is going to make new all-time highs this year. There were a couple of actually I'll get to that at the daily chart level. At the weekly chart level, this week has a long upper wick. I have to read that as bearish. Price has still managed just to close above support. I should rename this support. I'm sorry, that's wrong. This is still support at 2800 to 2815. Price is still just above support at 2800.71. And so support remains at that point at this stage. Price hasn't closed below support. At the weekly chart level, the candlestick is red, although there's a higher high and higher low. Price moved upward, but the candlestick is red and the balance of volume is down. Downward movement within the week shows less volume. Price is falling of its own weight within this week. Volume isn't at the weekly chart level pushing it lower. On balance volume is making new all-time highs prior to price. I read on balance volume also as a leading indicator. This supports a longer term bullish outlook, expecting new all-time highs this year from price. That does not preclude pullbacks along the way up. That's a normal part of market behaviour. RSI is neutral. There is still room for price to rise or fall. ADX at this time frame is declining. The DX lines are whipsawing. There is no clear trend at this time at the weekly chart time frame. And MACD is bullish and almost full bore bullish. At the daily chart level, there is a bearish engulfing candlestick for Friday's session. It doesn't engulf Thursday, but it does engulf this 1, 2, 3, 4, and this 5. These 5 prior candlesticks here. So it's a fairly strong bearish engulfing pattern. The bearish or candlestick reversal patterns, first of all, they need to have something to reverse. This one comes after a sustained upward trend, and so it's a reversal pattern. But they make no comment whatsoever on the direction of the next trend, nor how long the next trend is going to last. Another way of saying that is it's a reversal pattern, but it's not going to tell us if it's signalling a small sideways consolidation or a complete 180-degree reversal and a new downward trend. It doesn't tell us that at all. And so this bearish engulfing candlestick pattern could be followed only by a little bit of downward or sideways movement. In order for me to expect that there has been an end to this upward trend, we need to see a new swing low. From this low, so far, there has been a series of higher highs and higher lows, the basic definition of an upward trend. While the last swing low remains intact, that overall picture remains intact. There is still an upward trend in place. Within this upward movement, there is some support from volume. There was this strong volume day, also this strong upward volume day. For Friday's session though, volume was actively pushing price lower and price is closed about the low for the day. With a close about the low for the day and support from volume for downward movement, it looks like Monday may see more downward movement. It may be limited though, because on balance volume is exhibiting now some weak bullish divergence. This downward movement isn't necessarily that strong, and so downward movement may be limited. ADX now declines. There is no clear trend anymore at the daily chart level. ATR is overall still flat. RSI neutral. There is room for price to rise or fall. MACD is whipsawing. It gave a bullish crossover. Now it gives a bearish crossover. And stochastics may be returning to neutral. The weekly chart level, this is the all-time high from price, and this is the all-time high from the AD line just last week. The AD line is making new all-time highs from and price is not yet doing so. Where the AD line leads, price usually follows. And so this is a very strong bullish signal. I expect price may follow this year to new all-time highs. At the daily chart level, both the AD line and price declined for Friday, but the AD line is not declining any faster than price. There is no short-term divergence. Downward movement for Friday has support from normal corresponding fall in market breadth, but market breadth is not falling any faster than price. However, with inverted VIX, there is some divergence. At the weekly chart level, inverted VIX has made a new short-term swing low, but price has not. As price was falling, VIX was increasing. VIX is increasing faster than price is falling, and so that's some bearish divergence for the short term. This would tend to support the alternate Elliott wave count, but I expect there is more overall support for the main count. At the daily chart level, though, there is no divergence. Inverted VIX has not quite managed to make a new swing low here. Price hasn't managed to make a new swing low here. At the daily chart level, inverted VIX is falling very fast, but not faster than price. I'm just going to quickly go back to the daily chart, classic technical analysis chart. At this major low here back in December, there were a couple of 80% downward days and a 88-point-something% downward day here, followed by a 90% upward day here and here. That represents a 180-degree reversal of sentiment, or reversal from a strong downward movement to a strong upward movement. And that's normally associated with major market bottoms, not an interim bottom. For that reason, I've been quite bullish on the way up here, and that upward trend remains intact. Those 80% and 90% days are one really big reason why I am expecting new all-time highs from price this year, and I do not expect these December 2018 lows to be taken out at this time. That's all from me with your S&P analysis this week, and I hope that all of our members are having a fabulous weekend.